Hello everyone, Whitney Morrison here. Welcome back to the Holistic Money channel. In today's video, I'm going to talk with you about stock market investing. Specifically, I'm going to talk with you about 3 ways to begin investing outside of your 401k account if you haven't already. Excited for this video today because I haven't done much stock market education on my YouTube channel just yet, so this video is going to be one of my first. Some of you may or may not know this about me, but I actually started my career as a financial advisor 12 years ago at Wells Fargo Advisors. And I am very happy that I'm not working there today, but I'm very happy it actually is where I started my career. And there are a couple of reasons why. Number 1 is because I really did learn the ins and outs of stock market investing and all of the different options that are available. And number 2, I learned some of the behind the scenes information and knowledge that perhaps regular consumers or investors on the street may not know about fees that you get charged when you are investing with large national banks or buying different mutual funds or investing on different platforms. So in this video today, I'm going to spill it all. I'm going to tell you all the information that I know about the different ways to invest to empower you to choose the way that makes the most sense for you. I'm going to talk about the pros and the cons of each situation and also the fees associated so you can make the best decision moving forward. Now, before I get started, I want to talk about why it is important to make sure that you are not just investing in your 401k. Yes, investing in your 401k is good, but the thing is that a lot of us are exclusively investing in our 401ks alone. And we want to make sure that we are not just investing in our 401ks, and that is because we have a whole life that we are going to live before we hit our retirement age. So if you take money out of your retirement accounts before 59 and a half, you're going to have to pay taxes and you're going to have to pay a 10% penalty. And a lot of people end up doing this in some way or another because they are not putting money away for their life expenses. So when you invest exclusively in retirement accounts, you are not giving yourself any kind of leeway to have any kind of life or any kind of life changes. And I really believe the environment and the economy that we live in today, it is going to require that we invest outside of our 401ks because I don't think that people are going to just stay at the same job for 20 or 30 years anymore like they used to. I think people are going to take these little mini retirements, and these mini retirements are going to be periods where you are not working. And if you don't want to be incredibly anxious or financially stressed during this time, then it is important that you have investments outside of your 401k to help cover you during those times. And likely what I expect is going to happen is people are going to have more of these mini retirements. However, they're likely going to work much longer. And in my eyes, this is what makes much more sense for our new world because people are living longer, they are staying healthy, and most people don't have enough money saved in their investment accounts to afford 20 to 30 years of retirement. All right, so there are 3 ways to get started investing out of your 401k accounts. The first thing that you need to know is any investment that you make outside of your 401k or outside of your retirement accounts is going to be held in what is called an after-tax brokerage account. And this after-tax brokerage account is going to act like a big bucket. So what will happen is you will choose specific investments to put inside of your after-tax bucket. And your bucket will just hold all of these different investments. Now, the way that you choose your investments, how much you pay for them, that is what I'm going to go over today and give you 3 options so you can choose the best way to move forward. Option number 1 is to build a portfolio yourself. And what this would look like is you would go to a brokerage firm, so perhaps Fidelity or Vanguard or even Robinhood, and you will open an after-tax brokerage account. And then you will be responsible for picking all of the different investments that are going to go inside of that after-tax brokerage account. The pros of this strategy are that one, you have complete control over what you invest in. So if you are a socially responsible or conscious investor, you can choose specifically which companies you do want to invest in and which companies you do not want to invest in. The next pro is that it likely will be your cheapest option in terms of upfront cost. So you are not going to pay anyone to choose the investments on your behalf, so you'll get to save money on fees. The cons of this strategy are the fact that you are responsible for managing your portfolio. So you're going to have to do things like choosing your asset allocation, which is your division between stocks and bonds and cash. And what that really means and what that really determines is the amount of risk you are going to take on in your portfolio. The next thing that you have to worry about as a DIY investor is rebalancing. So what that means is as you choose an initial asset allocation for your portfolio, as time moves forward, your stocks and bonds will grow at different rates. And what that means is that your original asset allocation will get out of whack. So over time, you want to make sure to rebalance your portfolio to make sure that everything stays within the original asset allocation that you determined for yourself at the beginning. And the reason why that is important is because remember, like I said earlier, your asset allocation determines your risk. The next thing that you'll be responsible for as a DIY investor is selling off your assets to get income. So ultimately, when you're building these investments, at some point, you do want to be able to draw income off of your portfolio so you can live or buy a house or whatever it is that you're doing with these investments. One thing that you have to do as a DIY investor is choose how you're going to sell your positions to be able to draw that income. And this doesn't necessarily have to be a con, but you just need to be aware of the things that you need to know to be able to properly manage your portfolio moving forward. Now, although DIY investing can be your cheapest option, you still want to be aware of some fees that can come along with this strategy. Number one is to pay for your trades. Now, we actually have entered into a new era of $0 commission on trades, which is something that was unheard of in the past. So there are actually a lot of brokerages that you can invest at now where you pay $0 for trading fees. However, that is not always the case. So you want to make sure that wherever you do try to invest at, that they have either a flat rate or hopefully a $0 trading commission on buying and selling stocks. The next fee you want to be on the lookout for is something called an internal expense ratio. Now, we have been talking a lot about buying individual stocks and individual bonds. However, there is also another investment called a fund. And a fund can either be an index fund or a mutual fund. And an index fund is a passively managed fund, and a mutual fund is an actively managed fund. Now, depending on whether you choose an index fund or a mutual fund will determine what is called the internal expense ratio. And the internal expense ratio is a fee that you pay to whomever is managing this money. Now, with a mutual fund, like I said, it is an actively managed fund. So what that means is you are paying an investment manager to choose the companies that go in this portfolio. And ideally, this investment manager has a lot of great experience and is really great at picking what we consider to be the winners. Now, historically over time, a lot of these investment managers have only predicted correctly 30% of the time. So a lot of the times when it comes to these mutual funds, you may or may not actually be paying for a professional who is choosing the winner. When you look at a mutual fund, you will see what is called an internal expense ratio. And this is the fee that you will pay to that fund manager. Now, this isn't a fee that you're going to see come out of your brokerage account on a monthly basis. It's not like it is a visible fee, but it is a hidden fee and it is reflected in the price of the fund. So one thing you want to be aware of as a DIY investor is if you are going to be investing in mutual funds, you want to understand what that internal expense ratio is. On average, it can range from 1 to 2.5%, and that is a lot. That is a big range. So you want to make sure that you know your internal expense ratio for your mutual funds. You can also stay away from mutual funds altogether and buy index funds exclusively. Index funds are so inexpensive because they actually don't have a fund manager. So they don't have anyone out there trying to decide which company is going to do the best or which company is not going to do well. Basically, they just buy a little bit of everything. And what happens is when you buy an index fund, you get exposure to the market at large, and you get to just pay less money with a diversified exposure to whatever the market does. All right, now let's move on to option number 2, which is to pay an investment advisor or a financial advisor to build a portfolio on your behalf. The pros of working with an investment manager or a financial advisor is the fact that they will take care of your portfolio for you. So they will choose your asset allocation, they will build your portfolio and manage it over time. And in addition, they should also do some other things with you, like help you plan out your financial goals, work with you to build a budget. Although you guys know that I don't budget, I money map. So if you haven't already, check out my video on money mapping because I will teach you a new system to manage your money that's way better than budgeting. But they should be helping you with your bigger financial plan. Another great thing about an investment advisor and a financial advisor is they should be able to help you understand market conditions. So hopefully to prevent you from making any emotional investing decisions that maybe you would if you were a DIY investor alone. Now, the cons of working with a financial advisor or an investment manager to build your investment portfolio is the fact that it can be one of your most expensive options. So there are a variety of fees that you have to look out for when you're working with a professional, and more often than not, you're paying a lot more than you actually think you are. So very similar to DIY investing, some of the same cost transfer over. So number one, if you have a brokerage account where your financial advisor is trading stocks on your behalf, then it is likely that you may be paying a commission per trade. So you want to make sure and ask, hey, are you going to be trading on my behalf? And if so, am I going to have to pay for each trade that you make? And the other fee that you have as a DIY investor that you will also have if you work with an investment manager or a financial advisor is the internal expense fee. So this can actually even be a little bit higher when you work with a financial advisor. So it really depends if they're going to be investing in index funds on your behalf or the mutual funds on your behalf. But that is an additional charge that you pay regardless of if you're paying for a financial advisor or not. The new fee that you're going to pay if you're working with a financial advisor or an investment manager is called a management fee. And this is a fee on top of the per trade commission fee and the internal expense ratio. So it is in addition to those fees. Now, the management fee is the fee that you pay your investment advisor or your financial advisor to manage your assets on your behalf. It is about 1% to 2% on average. So you want to make sure that you understand exactly what this fee is. Now, this may not seem like a lot of money, but over time, this builds up and can be incredibly expensive in the long run. So every dollar that you take out of the portfolio, not only are you paying it to someone else, but you're also losing out on the opportunity to grow on this money over time. Now, I'm not saying that this is a good or a bad option. I just want to make sure that you are aware of all of the fees that you will pay if you work directly with a financial advisor or an investment manager to manage your portfolio. Option number 3 is a nice combination of option number 1 and number 2, and that is to invest with a robo-advisor. The pros of using a robo-advisor are the fact that you get a professionally managed portfolio for a fraction of the cost. And what does that mean? What is a robo-advisor? A robo-advisor is a digital investing platform, so it is done completely online. You do not deal directly with a financial advisor or an investment advisor. Instead, what you do is you tell these platforms about yourself. So you tell them your age, your risk tolerance, you tell them what you're going to use the money for, and they will give you a suggested diversified investment portfolio. From there, the technology actually manages your portfolio over time. So they will do things like rebalance your portfolio, which we talked about in the beginning. They will choose your asset allocation. They will help you sell off your investments and choose strategically how to do that for you when you need to actually take money out of your portfolio. And they will also help you with something that is called tax loss harvesting. So there are a lot of great benefits to using a digital investing platform. Another great pro to a digital investing platform is the cost. So instead of paying 1 to 2% in management fees, you are actually only going to pay 0.25% to 0.4%, depending upon which platform you choose. And this is significantly lower than going to work directly with a professional, and you still get the same diversified portfolio available to you. The cons of using a robo-advisor are the fact that you may or may not have access to human advice. And so this is something that may be very important if you're a new investor or that you might get freaked out and sell. However, if you stick to basic investing principles, you shouldn't have any trouble using a robo-advisor. Another con of using a robo-advisor is that you have limited control over your investment portfolio. So if there's a company within the portfolio that you don't like, that you don't want to invest in, or if there is a company that you do want to invest in, you actually don't have any control, and your portfolio is going to be designed and managed exclusively by the technology and does not have any ability for you to have your human influence over the portfolio. And this in some ways can be really good, but for those of you that are looking for a customized solution, this may not be it. So the fees associated with using a robo-advisor are similar to some of the fees that we talked about in option 1 and 2. Robo-advice platforms invest exclusively in index funds, so you don't have to worry about investing in any of the high internal expense ratios that you experience when you invest in mutual funds alone. So you're looking at 0.1% to 0.4% depending upon the index fund for every single investment within your robo-advice platform. The second fee that you have to pay is your management fee, and that is 0.25% to 4.4% depending upon which robo-advice platform you go with. Some of my favorite robo-advice platforms are Betterment, Ellevest, and Wealthsimple. So as you can see, there are a variety of options to get started as a new investor investing outside of your 401k account. You may actually decide that you want to do a combination of some of these strategies. Some people like to do a DIY investing portfolio for a very small amount of money, and then complement that with a robo-advice portfolio that they end up holding on to for the long run. So I hope this video gives you some perspective and some insight on how to get started investing in the stock market, and I hope you are able to choose the path that works best for you. If you like my content, please make sure to subscribe, share, and comment below. I love hearing from you guys, and I love being in conversation about information in my videos, so please make sure to comment. Again, my name is Whitney. I put out new videos every Monday, and I hope to see you soon.